off. Thank you everybody so much for being here at our SAMF seminar for November. In 2025, it has been a journey. So returning to tell us about frictional capital markets and economic growth, returning is Guillaume Rocheteau from UCI. Please, Guillaume.
Thanks a lot, Lucas. So this is a paper, Frictional Capital Markets and Economic Growth. So, okay, I need to get this to work. Okay, so I will start by misquoting Solow. So it's a famous quote from Solow that we recognize. So we may predispose ourselves to misunderstand important economic aspects of economic growth if we insist on modeling the buying and selling of capital within a set of background assumptions whose main merit is that they are very well adapted to models of the buying and the selling of clothes. Okay, so that's going to be what the paper is about. So a theoretical investigation into the microstructure of the market for capital goods. And I'm going to ask how it matters for the misallocation of capital across firms and for long-run growth. So it's going to be a paper about how misallocation and growth correlate when there are changes in the structure of the market for capital goods. I'm going to consider two changes as search friction diminish. So you can think that over the last 20 years, there have been this development in terms of online trading platform for capital goods, for instance. Or you can think of changes in market power of intermediaries, a rise of market power or a decrease depending on how you view this evolution. I'm going to ask follow-up questions. Is higher misallocation always associated with lower growth? And I'm going to ask if the welfare gains from removing the market friction are always positive. So why should we care about the structure of the market for capital goods? So I would argue first, related to the Solow's quote, a large literature has been devoted to the market for labor, so it seems reasonable to spend some time on the market for capital. In addition, capital is central to economic growth, so I would say most growth models are based on capital accumulation, even though the Nobel Prize this year was a theory based on innovation, and I will get back to that. Capital accumulation is a source of knowledge, so there are classical papers on that, Arrow and Romer, for instance. So the two together, the fact that capital matter for growth and for the knowledge accumulation, give the potential for this market structure to be consequential. In addition, I would say, we care about that market structure because capital is traded, the new capital is traded, but also the used second-hand capital is traded. So capital reallocation, which is trade firms to firms, is 1/3 of total capital expenditures by some measures. It takes place in markets that have been documented as frictional. One example of that is the recent paper by Otenello that gives this measure of the unemployment rate for capital that is almost 11%. So larger than what we would think it is for labor, for instance. I'm going to start by giving you some observation on the market structure, so to motivate what I'm going to use in the model later on. So I want to argue that the market for capital good is well described as a dealer over-the-counter market. So the market structure for financial assets also works well for capital. And I'm going to distinguish those three ingredients. So I will argue that it has search friction, it has intermediaries, and it has components that are more or less centralized. So search friction, I would argue that now it's in fact quite well documented. So I will give you this quote, but some other forms of evidence. The quote for the search friction is maybe one of the earlier paper on the friction in the capital market was by Rami and Shapiro, and it was for the aerospace industry in Southern California. So you can read from the quote, but they argue that it's difficult to match the capital and the firm. The reason being, markets tend to be thin and there is costly search. So it's really some of these ingredients that we would think for model of search. It has intermediaries. So here I would cite Gavazza. So that was for the market of aircraft, where he argues that intermediaries play an important role. And I would argue that it's true for most categories of capital goods. And I will tell you a little bit more about that. And it has centralized and decentralized component. By this, I mean some trades are very decentralized between what I would call traditional dealers and firms. Get more centralized when you have trades on online platforms. Also centralized to some extent as you have this network of dealers. So you have this connection between dealers.
So Guillaume, can I ask a question?
Yeah.
So do you want us to take this idea that if something has a centralized or online platform, then it doesn't have frictions anymore? Is that like the limit you're going to be thinking about later?
And not quite, as a matter of fact. So
Okay.
yeah, the next slide I will argue, yeah, not quite. If there would be only one, I would, we could maybe argue like that. But it's not the case. So it's still very segmented, right? This would be
Okay.
that slide. So I would say, even though, there are those online platforms that seems to give a sense of, yeah, it's a bit more centralized. You can collect some information about some capital good on some of those platforms. Yeah, still, there is still a lot of those platforms out there. But presumably it still has some effect on search friction, maybe reducing them. So this development is relatively new. It's about 20 years old. One of the first platform being this machinery trader, so the one that you have on the left, second row. And then you have a bunch of them. You have eBay for heavy equipment and so on. It's an all industry, right? This dealership in capital goods. So here, this is this example. So it's also an online platform, but you can see it's 100 years old, right? So it was not online for 100 years. It's called Surplus Records. So it used to be a catalog, right? Initially, so it was created as a catalog, keeping track of all capital goods in the US and maybe even Canada, as a matter of fact. This was made for dealers. The dealers would post their surplus record. It was their surplus equipment. One interesting thing is it's closely, so it was created in 1924. So it was closely related to the First World War and in fact the Second World War as well. So the World Wars were creating all this surplus equipment and then a large entry in this market for dealers. Now you can see, so the posting would be typically dealers, right? So even though you have those websites, still dealers are very active. And you can see how for this particular platform, which is not the case, for all of them, and you can see that you can make offer, you can request price. So it looks like, the way we would think about bargaining. In fact, if you click on some of these blue buttons, you're going to get a screen like that where you can put your name and you can make an offer if you want to. And so I would say this is as close as it gets to doing bargaining. Okay, not all websites are like that. Sometimes you have auctions, sometimes you have posting. So you can have different types of mechanism on those platforms. So in terms of centralization, to go back to Ben's question, I would argue that like this network of dealers have kind of that flavor. So you have this network depending on the capital goods of dealers, and so this is taken from their website. So for the Machinery Dealers National Association, again you can see that they provide instant availability. So this is things that are going to remind you of the market structure I'm going to use. How the reason they can do that is because these dealers can communicate with each other through various means. I want to argue that it's not only physical capital, so it can also be intangible capital. So here it's the example of the secondary patent market. It's an old market, has always had brokers there. Again, you can see this quote. These brokers being critical, sell, buy, negotiate. And then again, you find this idea of a network of connections between those dealers.
Is it going to be important that that it's the buying of capital here versus renting? We understand that there's actually a fair bit of renting of capital, particularly for large firms.
Okay, so I mean, in the model, I'm not going to consider rental. My view is, my interpretation would be that, yeah, you can have a reinterpretation with that same friction with a market where there is some amount of rental. I have a follow-up work where I combine some rental market for the newer equipment with some market where you have to own for the older equipment, which I think seems kind of the realistic. So, but that's for some follow-up work that I will mention in my last slide. So I would say, I mean, I think to some extent, yes. I would argue that the friction still have to be there.
But the
yeah,
crucial
I'm
thing
not going to
here
have that
is
nonetheless.
that the
Yeah.
capital is very specific, like that there's still some you can't freely redeploy it to any other firm, that there's something specific to the capital, like the buyer and the seller ultimately.
Yes.
Like in the sense, but like airplanes are sort of like there's only a very particular few set of people that could have it, whereas if it's like computer monitors or like computers, there'd be a much wider range of.
Okay. So I
So
would say,
presumably the search frictions and the value of sort of the frictional size would be sort of much more
yeah,
larger for the airplane side than others.
yeah, I agree with that. So, so I did emphasize that in some of the earlier slides, right? So I have this measure of turnover for this capital goods on those platforms, and so it certainly varies across capital goods, right? So it's not that it's uniform, but so the thing I didn't mention, yeah, the delays are large, as a matter of fact, can be very large, so 6 months, 9 months, a year, and yeah, it vary a lot in terms of the capital goods, whether they are very specialized or they are more common piece of equipment. Yeah, so I think that's true. I'm not going to go into that amount of detail in the model, as you will see, because this is what I have on that slide. So the model is going to be parsimonious. So the market structure is going to be summarized by 2 parameters, and it's going to be tractable based on some textbook models of growth. So in fact, Romer essentially. There will be firm heterogeneity and idiosyncratic shock that's going to generate the need for trade. There will be this market for capital goods going to look like what you have in your neoclassical model. So in that sense, I'm not going to go into these different types, even though I can talk a little bit about that later. And the market is going to be described as an OTC dealer market. There will be knowledge externality, just like has been advocated for capital goods by Arrow and Romer. And I'm going to see what an implication of this for misallocation of capital, for the rate of return on financial wealth, and for economic growth. If I have time at the end, I will try to get into, to endogenize this dimension of the market structure and see how that matters. Well, I'm going to argue that, in terms of what comes out of it is that there will be 2 dimensions of misallocation. One is going to be static, so that's going to be about, for a given stock of capital, is the capital stock well allocated across those heterogeneous firms? So do we get the highest amount of output given that capital stock, or how much do we lose relative to the best allocation? The second dimension of misallocation is going to be dynamic. So it's going to be the pace at which you accumulate the capital. So it's going to be about the growth rate. I'm going to tell you that those 2 dimensions are affected differently by the different dimension of the market structure. The second point I'm going to make is that there are some changes in the market structure that increase the static misallocation and do not necessarily lower the growth rate, right? which would be somehow the intuition. So you can have some non-monotone relationship between some of this friction and the growth rate, for instance, or you can have a change in the market structure that increase the static misallocation that in fact going to promote more growth. And the last thing, in terms of some of the key results, I'm going to show that getting rid of this market friction can in fact reduce the growth rate and can increase and can reduce welfare, even though it might improve the static misallocation. Okay, so the theme is going to be that, yeah, there is some subtle relationship between the misallocation and growth when they are generated by changing the market structure. Okay, so I will start with a benchmark model. I think that's going to help understand how that works. So in that benchmark model, that will go with intuition. So when I'm going to increase the search friction or the bargaining friction, that's going to raise that static misallocation. So capital is not going to be well allocated across firms, and that's going to lower the growth rate. But as soon as we start introducing, some component that have been viewed as natural in the context of growth, like this knowledge externality, now we can get this non-monotone relationship. So it's possible that something that raised the misallocation might also increase the growth rate.
Guillaume? Oh,
Yeah.
okay. I was gonna ask a question about entry of brokers. I guess you are explaining it now, so I'm gonna wait.
Yeah, so at the end, I don't know if I will have time to get there, but at the end, yeah, I try to endogeneize both the entry and in fact also the bargaining power, as you will see. So for the entry, that's going to be the same theme, that something that might increase the static misallocation, so might not necessarily lower the growth rate. Also, there can be, raising the bargaining power might in fact lower the misallocation in that case, and the effect on growth can lead to lower growth or higher growth. And in that last case, I shut down the knowledge externality, so it really comes through the entry margin.
Guillaume, in the model, in the version of the model with entry of brokers, is the equilibrium constraint efficient? If we have a planner maximizing the social welfare by taking as given the frictions?
No, it's not going to be. So you still have these search externalities and holder programs, right? So that's going to be the common theme throughout holder programs.
I see.
And then when you have entry of brokers,
doesn't
you have on top of that the externalities associated with the entry.
Okay, I see. Thank you.
Let me say, I don't want to go through all the literature. I think the paper I'm trying to be reasonably thorough, as a matter of fact. So, but I would just emphasize a few. So I think one paper that is closely related, I would argue, is the paper by Otenello, the recent paper. Is using the market structure is different. Is using a directed search model, so there is no emphasis on bargaining power, intermediaries, holder program, and it's not about growth, but still related in the sense that it is a paper emphasizing search friction, in particular in the context of a business cycle.
Well, Guillaume, I have this paper with Yuzu and Wei Ku.
It's coming. Be patient.
Okay, because I was going to say we don't have.
No, look, it's coming. You have to be patient.
Okay, I was going to try to drag out the differences. Oh wait.
Oh yeah. Yeah, no, it's coming. Give me just 1 minute. So it's closely related to the paper on the OTC literature, because the model I'm going to use is an extension of Duffy, Gallon, and Peterson for the market structure, and in fact, it's going to be related to my paper with Ricardo Lagos. The reason why I think it's important. So the model is going to be very tractable. That's going to be what I'm going to show you. And the nice thing is now we have this book by Ben and co-authors. So all the tools in this book, in principle, you can think of introducing them in what I'm going to show to you, right? So here, the relative to that literature is I'm going to take that market structure and embody that into a mainstream macro model of growth. So the supply of the asset is going to be endogenous. The real interest rate is going to be endogenous. The TFP growth is going to be endogenous. And there will be no reduced form in the interpretation of this utility function, for instance, right? So that, I would say that's really moving from the market structure literature into the macro literature. Way more literature on capital reallocation. So, I mean, you can see I'm not going to discuss all of them, but there's certainly the literature that, so there's a recent paper in the JPE, Kui, Wright, and Zhu. So yeah, the emphasis on liquidity. I'm not going to talk about liquidity, not in the sense of having a liquid asset or money facilitating trades here, even though I was doing it in some appendix. I still think it's something to do, but it's not going to be in that presentation. And there's a literature on Schumpeter and growth. It's not going to be about that either. So somehow I had to make a choice on the model of growth, and given the emphasis on capital and the literature that exists on the externalities associated with capital accumulation, I've chosen to be with the Arrow-Romer formulation. But I think in principle there is no reason to think that some of these arguments wouldn't work when you are trading intangible capital or when you're adding innovations. I think we can chat about that maybe later.
Question?
Yeah.
I think the environment you are considering reminds me of the market for GPU. which arguably is one of the most important like capital goods, right, in the world. And like there's a very active second market for that. And then there are like presumably like you can check all the transactions, I mean, all the price, and then like maybe some of the implication that you have in the model could be applied to that market, or maybe tested based on the data. It's more of a suggestion. Yeah.
Oh, great comment. Yeah, so we have been trying. So certainly I've been trying with quarters to get access to more data, in particular in China. So yeah, so kind of unsuccessful right now, but yeah, great comment. Thank you. Okay, so it's so the model is at that point is going to be hopefully is going to be as standard as it gets in terms of macro growth model. So it's written in continuous time. You have two goods, consumption good and capital good, 4 agents. So I could have 3. I could merge the household and the capital producers, but I think for presentation, I separate them. So there will be the infinity households, firms. Firms here is going to mean the producer of the final good, capital producers, and then there will be the new category that's going to be the intermediaries, the brokers. The preferences of the household, so it's a standard CRA utility function, the rate of time preference. I'm going to assume that the household do not own the capital, but they own all the financial claims, right? All the shares and so on. The rate of return on the financial wealth, the reinterest rate is going to be R. So capital here is going to be durable goods. I'm not going to include depreciation here. So I think for what I'm going to say, I don't think it matters, but we can certainly discuss that. I have follow-up work where I do introduce depreciation. Here is going to be perfectly divisible capital. Again, I have some follow-up work where I make it indivisible to introduce this idea of heterogeneity of capital goods, but not here. The capital producers, just like in the neoclassical growth model, have the technology to transform the final consumption good into the capital good 1-for-1. Capital stock is KT, the production is going to be K dot, or the change in the capital stock over time. As was mentioned earlier, here I'm not going to consider a rental market. So the firms are going to own and manage the capital they operate. And so okay, maybe yeah. So there is rental, right? So it's not that it does not exist. So I think here, I think there will be 2 views. One is those friction would still exist, but somehow would have to be incurred by the rental firms to some extent. Or I think maybe better approach is to have both coexist, the rental market and the market for ownership. Okay, but here there would be only ownership by firms. So here I'm going to have a unimeasure firms. They are going to make all their decisions in terms of capital, changing their capital stock to maximize their market value. The technology is going to take this form, so it looks like a production function intensive form in the growth model. So it's F of K, K being that capital stock. I'm abstracting from labor throughout. The index is going to be some idiosyncratic components. So the firm here can have a high idiosyncratic productivity or low idiosyncratic productivity. I'm taking that form for now. I'm taking the linear form in capital. All of that I'm going to relax later. So I'm going to have curvature in terms of capital. I'm going to have more heterogeneity in terms of those idiosyncratic components. The firms are going to redraw their idiosyncratic productivity at this Poisson rate lambda. When they redraw, it's IID, right? So you draw the high productivity with probability pi h, and a low productivity with probability pi l. Right, so as long as it is IID in that form, having 2 realization in the linear case is with no loss in generality. Now, if you would want to have a more general Markov chain, yeah, there will be some loss in generality. Right? Okay, I'm happy to also chat about that, but for now, that is the simple formulation where you move high or low essentially as a firm. The market structure for the capital goods. So it's deal over the counter markets in spirit of what has been done in that literature, Duffy, Gallen, and Pearson. So the firms are going to be matched bilaterally with brokers. So in order to adjust your capital, you need to go through brokers. the meeting rate is going to be this alpha. So here you need to measure firms and you need to measure brokers. So I only need one parameter for my matching technology. I'm assuming that the brokers form these networks, which is formalized in this idea that the brokers have continuous access to some competitive market. So the brokers can communicate among each other and find the capital that the firm needs. And that's going to be the assumption. The brokers have bargaining power, eta. And here I'm making the fourth is I'm making an assumption about the new capital goods. So I'm assuming that the capital producers can trade competitively with the brokers and can sell at this competitive price. So the capital producers are not going to be subject to the market power of those intermediaries. It will also have the implication that the new capital is going to flow directly to the most productive firms. Okay, so the market structure is going to have this form again, this interdealer market or this interbroker market where the brokers can trade at that competitive price PK. The firms will have to meet with those brokers to readjust, so that's going to create those delays, and the capital producers will be able to sell their capital instantly. Okay, so this is capturing, I think, some of these key ingredients. They are the stress friction, the alpha, they are the intermediaries, they are connected, and they have bargaining power. Okay, so let me describe how it works in terms of the equilibrium for this benchmark model. So the household is going to maximize the lifetime utility. The only thing he has to choose is how to accumulate the financial wealth, or is that rate of return. So again, no labor income here. Then we get out of that some earlier equation that is going to link the growth rate G to the real interest rate, so 1 for 1. Okay, so whenever I'm going to make some statement about the real interest rate, that's going to mean the same in terms of the growth rate. The capital producer is producing directly from the final goods, so 1 for 1, which means in order to get a solution, so I is going to be the amount of production, PK, at the price at which he can resell, 1 is the cost of production in terms of the final good. So in order to get a solution with positive production, the price of capital is going to be 1, just like in our standard growth models.
Guillaume, a clarification question.
Mm-hmm.
So here, with this capital production technology, are we gonna get that like producing any amount is optimal and a balanced growth path is we are gonna choose a balanced growth path and we are gonna choose that capital production rate as the equilibrium rate?
I'm not sure exactly what you mean by that.
So it sounds like investment I is linear here, so it's just
I mean, pin down the price. Essentially, what it means is the price of capital is always going to be 1. Throughout. So I'm going to have a balanced growth path, as you say. The price of capital is going to stay at 1, and that's going to be the key implication.
If there was a convex cost here as well, could we solve the model again?
Yeah, so I have a formulation which I think is more relevant when I'm talking about the knowledge externality. But I have a formulation of the model where, there is a separate technology to produce the capital, and the cost of production depend on the aggregate capital stock. So yeah, it works well. I'm trying to think. Yeah, I think yeah, no, I don't think there's an issue there. Yeah, you can do that.
Thank you.
Guillaume, can I ask a clarifying question? So,
I Guillaume.
hey, so who owns the households own the firms? So the brokers are mass zero here. So what happened with all the
they own the
they
broker.
consume?
So the
They
brokers,
also,
yeah, they will be owned by. So I'm going to have the financial value of those brokers as well as the financial value of the firms. All of that is going to be owned by the household.
okay, good. Thank you.
So okay, so I'm going to give you the equation for the value of the firm. Before doing that, I need to tell you how the bargaining takes place between the broker and the firm. So the value of the firm is going to be this Vj, depend on the capital stock of the firm and depend on this idiosyncratic component J, which is high or low. they are going to negotiate some compensation to the broker. That's going to be that fee, and the capital stock that the firm is going to leave the meeting with. So, you know, just like the type of bargaining we would have in this OTC literature. The firm surplus, I mean, you can see is going to be the value of the firm with the new capital stock K prime minus the investment. So that's where the price of capital shows up. It's 1 minus what is paid to the dealer, that's fee. And then in case of disagreement, you just keep your capital stock. The surplus of the broker is just fee. So we have this bargaining program with transferable utilities. So the fee is going to split the joint surplus according to the bargaining powers. And the capital stock K prime is going to maximize that joint surplus. So this is telling you that even though there is bargaining power here, it does not create distortion in a static sense here. So the trade is going to be Pareto efficient from the viewpoint of the firm and the broker. I'm going to use that when I'm writing the value of the firm. So this is the value of the firm, VJK. So discounting at this rate R, which is the rate of return of the financial wealth from the household viewpoint. On the right side, you have what the profits that this firm is going to generate, or the output flows. So the first one is the AK component that you can recognize. And then there is the possibility that you make capital gain. So you have this Lambda shock. Pi minus J means you draw new productivity. And then the value of the firm changes from VJ to V minus J. The last term is when you access the broker. You see here, because of this, the property of this transferable utility. So when you access the broker, you share the gains from trade. Right? So it's effectively as if you trade at that rate alpha times 1 minus eta. And in that case, you re-optimize. You choose your new capital. Okay, we allow for the possibility.
Sorry, yeah. Guillaume. How are you distinguishing here? I know you cited some of the innovation literature, but it seems here, but this is like could be reformulated as like in the Clem-Cordum or Lenson-Mortensen sort of model. Just so like capital, like since it's perfectly durable, it seems to have the same sort of properties as if it was innovation or knowledge capital. So what is like really distinguishing here your setup versus besides it? From what I can tell, it seems to be that the new capital that is created is coming from a different source, but is not the existing capital, like existing firms. But the firm problem besides that seems like I could reformulate this OTC access is just investment into expanding into new product line, and so it's just expanding the set of capital that you have. So is there something else fundamentally sort of like different here with the physical capital that you're modeling versus the innovation capital in that literature?
Okay, so I mean, in some sense, I would like to argue that it is not, it is not this different. So I mean, I would be happy to argue that, what I'm describing with capital could be interpreted as, physical or intangible capital. So it could be, to the extent, I mean, the point is that, the capital, you can trade it, right? So whatever the form that it takes, if you can trade your capital, you can trade your ideas. Generally, I think they for some of the, for some of the interpretation of the capital, in particular, the assumption regarding the divisibility of it, regarding to, so some form you might think is more indivisible than others, for instance. But otherwise, yeah, I'm happy with a broad interpretation of the capital that is traded here.
The idea market is a little trickier. With capital, you can repossess it if they don't pay. If I sell you my idea and you don't pay, it's hard to take it back, depending on patent laws, intellectual property rights, etc.
Yeah.
No, of course, so with the rival versus non-rival aspect, there's all sorts of things I was just trying to.
But that's going to come up. I'm going to introduce this knowledge externality, right, in a few slides. So in that sense, that's going to make it even closer. Yeah, to go back to Randy's point, here there is no financial friction whatsoever on the firm side, right? So otherwise, yes, so some of this consideration would matter as well.
But so
presumably you can add that.
Sorry, go ahead, Randy.
I was just going to say, presumably you could generalize the model to take into account liquidity.
Yeah, so
It's kind of what you do.
Yeah, there's an extension. No, exactly. I have an extension in the appendix. I don't do it in the main paper because I think it deserves somehow more attention. But yeah, absolutely can do that. That would in fact resemble a little bit what Ricardo and Shengxing do when they have this turnover of asset and they have this liquidity constraint. I think that would go the market structure and this liquidity would go a little bit in that direction, as a matter of fact. So for this formulation, so the value of the firm is going to take this form of a Tobin's Q times the capital stock. So the linearity is going to be the linearity in the production function is going to be reflected in that way. It means that the Tobin's Q of all these firms will have to be less than 1 in order to get a solution when the firm has access to the market. And in fact, in order to get market clearing, the highest Tobin's Q will have to be equal to 1. So that's going to be the Tobin's Q of the most productive firm. So you will see later on when I'm going to talk about the determination of the real interest rate, that's going to be through market clearing, and that's going to be essentially setting the Q of the most productive firm to 1. Well, we get closed form solution for this Tobin's Q. So the first term is so maybe I should start, in fact, with the second term, that liquidation value. So the Tobin's Q is going to be the fact that you can resell the second term. You can resell your capital when you have access to the market, and you can resell it at price 1. So this is going back to the assumption earlier. But you cannot do it instantly. So there is this discounting. There is the rate at which you can do it, alpha 1 minus eta, and then there is a discounting involved there. If you have no friction, the alpha goes to infinity. That's 1. So your Tobin's Q is equal to 1. The friction means you cannot sell it immediately, so you also have to take into account what happens in between before you can resell it. That's going to be the first term on the right side. And that term is going to capture the fact that you have your current productivity AJ, but your productivity might change before you have the opportunity to readjust your capital. So that's the second term where you withdraw your productivity at red lambda. And again, the friction, you see them affecting that first term, and you see that they work as a product of the matching rate and the bargaining power of the firm. So as Guillaume was mentioning, so we can price those brokers, and they are going to be owned ultimately by the household. The value of the broker is going to be determined by the gain that they make by reallocating the capital, by moving the capital from the low productivity firms to the high productivity firms. So KL is going to be the aggregate stock of capital owned by low productivity firms. And each time you can move that capital, you are going to make that gain that is equal to the AH minus AR. And how much you can gain, right, is going to depend on the outside option of the firm in that negotiation. So in the denominator, you see this alpha 1 minus eta term. It's not going to be very important because I don't have the entry. When I'm going to have the entry, of course, this value is, or this equation is going to play a bigger role. We can compute the distribution of the capital suddenly in terms of here, that's all we need to know, the capital that is operated by the high productivity firms and the capital that is operated by the low productivity firms. So the first equation is giving you this law of motion for the high productivity firms. So you can see, so the first term on the right side is going to be the flow of capital that was owned by the low productivity firm that is going to flow toward the high productivity firms when they meet the market, when they meet the brokers. The following two terms means capital is flowing essentially when the firms receive the productivity shock. So for instance, if you have a low productivity firm that receive a productivity shock that makes it high, then it's as if that capital is flowing toward the high productivity firms. And the last term on the right side is just capturing the assumption that the new capital is going to flow directly to the high productivity firms because the capital producers have direct access to that market. And in the market, the capital flows toward the high productivity firms. So we can compute the share of the capital K hat H, that is the share of the total capital stock that is owned by the high productivity firm. So it should be 1 without friction, and then it's reduced by a term that capture that misallocation. So it's less than 1 because of this idiosyncratic productivity shock, as well as the friction, and as well as G that is playing a role, so the endogenous growth rate. Okay, so if I sum up, so we have the the
Guillaume,
total
just,
output.
can I
Yeah.
ask a clarification? So the
Yeah,
high
yeah.
productivity firms always want this K dot? Is that like baked into the model?
Here, yes. I mean, it's based in the market clearing, really. So the demand for, so there are two types of firm, right? Some are going to buy, some are going to sell. So the high productive firms are going to buy, the low productive firms are going to sell in that market. So this is related to what I was saying earlier. Once you have these IID shocks, yeah, it's going to be always like that. Now, if you have a more general Markov chain, depending on the transition across those productivities, it doesn't have to be like that, right? It's not something I talk about in this paper, but in some follow-up work, yeah, I discussed that. So yeah, it's not necessarily the one with the highest instantaneous productivity that should buy the capital, more generally. But when you have this IID structure, yes, that's going to be like that. So the output can be written as capital stocks times some productivity term that I call TFP. So this is the average productivity of the capital that depend on this K hat, which is how the capital is distributed between the high and the low productivity firms. I'm focusing on balanced growth paths here. So consumption capital are going to grow at the same rate G, which is determined by the earlier equation. The financial wealth is going to be owned by the households, going to take the form of the value of the brokers, as well as the value of the firms, which is valued according to this Tobin skew that we saw earlier. The real interest rate is determined by market clearing. Here, the market clearing is going to be that the highest Tobin skew, which happens to be the one for the high productive firm, is equal to 1. And that gives us this expression for this equation for the real interest rate. So R is equal to the highest productivity, which is what you would expect in the frictionless world, reduced by this term, which I call this illiquidity discount, that depend again on the idiosyncratic shock as well as the frictions. I mean, R shows up, just to be clear, right? So R shows up also on the right side, right? But you can see the determination. We get a unique real interest rate, +1. The equilibrium is going to be unique, right? The R is determined from the equation on the previous slide, and then you can determine the rest, the growth rate, and so on. There are conditions, nonetheless, to get a positive growth rate and to get finite lifetime utilities, just like you would have in an AK model. Okay, so let me say a few things about some things about the misallocation, which is the theme. So
Guillaume, before we go there, can you help me on something?
Yeah.
Because something that I'm missing is how the eta enters into the interest rate of the households, because eta is the bargaining power. So my intuition tells me that it doesn't matter who gets the return, whether the broker or the firms. For the households, it shouldn't matter, right? But you're saying it does matter for R. So I'm just trying. Yeah, so I'm trying to get the intuition of that. Why eta enters like that? Thanks.
Yeah, so it is true at the end of the day, what is captured, what is captured by the broker is going to go back to the household. But still, when you are pricing the firm, right, the firm cares about how much of the gain from trade. You see that on that equation, right? The firm cares about the share of the gain from trade, that is going to receive when it reallocates its capital. And it's only going to receive a fraction of that. So when you invest in this financial wealth, you know that your return is going to be, some of it is going to be less than the full gain from adjusting your capital stock. I'm not taking the sum, right?
And that's not going all to the brokers. And so where this is, because the alpha is very clear that this is lost, but
it's
I'm
lost
missing the intuition of the eta, how the eta enters into R.
So when I'm buying those stocks, right? When I'm investing in these firms, again, when I'm computing the return, the firm is not going to get the full return from adjusting its capital stock.
I see.
It is true that it's going to be captured by a different firm, but it's a different firm. When I'm making my investment, I'm not thinking, yeah, you can invest in the other firm, and that other firm is making its business through that intermediation. But each firm is going to be priced separately.
You're saying there's a holdup problem.
Yeah, there's a holdup problem. But what I think Guillaume is getting at is, of course, if I can consolidate, right? It's true that in in my portfolio, I'm going to get the return of these firms, which is going to be cut by the fact that they are trading with the intermediaries. I can also own the stocks of the intermediaries, and I'm getting it, but these things are still not priced as a bundle. I'm pricing the firm, the final good producer, and I'm pricing the intermediary separately. And the intermediary is cutting on the gains on the. So, let's say if he has all the bargaining power, when I'm adjusting my capital, I get nothing out of that. So from the viewpoint of the investor, investing in those stocks is not going to give you gain when the firm is adjusting its capital stock. Right, so there's a whole other program, to go to, essentially,
I see. Thanks.
Okay, so I think that's going to come up again here, right? So how this term enters into the two dimension. So one is that average productivity. So to go back to that, so if you look at the average productivities, it's AH, the highest productivity, cut by some amount. What you can see is that in fact the bargaining power doesn't show up there, right? So the fact that there is intermediaries that have bargaining power that capture some of it is not going to be reflected in TFP, not directly, only indirectly through the growth rate. And the reason is when the firm accesses the capital market, the capital always flows in the right direction. The fact that you have bargaining power doesn't matter at that point. There is no misallocation generated by the bargaining itself, which again doesn't have to be true if we have a more general Markov chain, right? So but in that, for this description, no direct effect from the bargaining. The bargaining here matters only in a dynamic sense. So the whole program is truly dynamic, which I guess is always dynamic, but the bargaining is efficient. But then you're always looking forward and saying, the next time I'm going to bargain, I cannot contract with that next dealer. And when I'm going to change my capital stock in the future, at that point, some of my gains from readjusting my capital stock, they are going to be captured by the dealer. And now this is reflected in that real interest rate. Now, those two expressions nonetheless look quite similar. So the R and the TFP, but not the same. Right? So if I put them one next to the other, I mean, you can see that one has the alpha but doesn't have the bargaining power, and one has the bargaining power that shows up. And I'm going to give you one reason why we might care about that. But at this point, I would say, so if I'm changing some of the parameters of the model, so the misallocation and the growth rate, they are going to cover the way you think they should. So the first two columns, the alpha and the eta, so this is the market structure changing. That's going to affect the misallocation and the growth rate in the opposite way. But this is also true if you're changing the idiosyncratic shocks. So anything that is going to worsen misallocation is going to lower growth rate. Now, to go back to the distinction between the static and dynamic misallocation, so in the model, is it possible to have, so can we explain that you have little incentive to invest despite high marginal product of capital? The answer is yes. So you can have high TFP and low R. So low incentive to invest, even though TFP is high. And what you need is, you see, so you can get a necessary and sufficient condition, but in that case, I'm only giving you that condition, which is clear to see that it can easily be satisfied. So alpha times eta is to be larger than this productivity of the most productive firms. And the reason it can be easily satisfied is alpha here is not constrained, right? So it's a Poisson rate can be as large as we want. So provided that the bargaining power is not too small, let's say close to 1, then that condition is going to hold. So you will have high TFP, low R. Okay. An extreme case is going to be that.
Sorry.
Okay.
I guess maybe if you allow for alpha to be heterogeneous, like firms choose their rates based off of their existing productivity, would that eliminate both of these misallocations here?
I don't think so. I want to answer too quickly. I don't think so. It's a bit harder, right? So if you have something adding a search intensity, something like that, if you have in mind, so that you could have heterogeneous meeting rates. Yeah, it's a bit harder to do that. But my intuition at that point, yeah, I don't think that would alter those results to be. I have not worked that particular case out, but yeah, my intuition would say no. I don't think so. I don't think that would matter. We can check. I might be wrong, but I don't think so at that point. Yeah, so here I'm pushing the alpha to infinity, right? So two reasons for that. One is related to the previous slides, but also is to see if the model behaves, in the right way. So converging toward like a textbook Romer model, let's say. So yeah, the answer is yes. So the first case, provided that the bargaining power is less than 1, yeah, the mid allocation goes to 0. The TFP goes to its maximum AH. The intermediation profits goes to 0. So you converge to an AK model at that point. But if eta is equal to 1, then you get into a version of the diamond paradox. So the competitive forces are shut down. So in that case, the misallocation will go to 0. So there is no misallocation. TFP is very high, right? So that's its maximum AH. But the real interest rate stays below AH. So you have a low real interest rate despite having a maximum TFP. So my thing is knife edge, right? Because it's eta equal 1, but I think, the same would be true that if eta is a little bit less than 1, it would really take a very high alpha in order to make you converge. Okay, I'm not going to say too much on that. So it's related to a question that was asked earlier. So, but not with the entry margin. So here there's no entry margin. If you look at the prime of the planner subject to the search friction, yeah, you would like to shut down the Hollow prime. You would like to shut down the bargaining power of the intermediaries. Obviously, this thing really depends on whether there is entry or not. Okay, so in the time that I have left, I will. So I have 10 minutes. I will tell you. So now you understand the mechanics of the model. So I think I will be able to go a little faster. So here's about generalizing the model. So to have curvature with K and to introduce this knowledge externality that have been emphasized, for instance, by Arrow and Romer. So you can see from Arrow, it's paper on learning by doing. So you identify the production of the capital goods, what is called this index of experience. And this is really the idea that was documented throughout the literature that, you create innovation by producing capital goods. So the capital good that you produce, they're operated by firm, and that gives idea for the next generation of these capital goods. You learn about what they can do, what you need them to do, and what the next generation should be. So here, this is going to be.
I wanted to ask something before you move on. So you're just giving away the new capital to high productivity firms, and that sure simplifies things. I was thinking if that wasn't the case, and if there was a competitive market to buy from, so that the high in equilibrium, they would still get the same amount, but they would have the option to buy more from the competitive market by paying whatever the price is, as opposed to be relying on the brokers. Would that does that matter?
I mean, yeah, I think when you are going to change somehow the market structure, yeah, my view is, of course it has to matter. So you would have in mind that something like some market for new capital coexisting for market. So one market that will be frictionless, coexisting with some market that will be frictional.
Yes,
something along those lines.
The important thing there is only the buyers have this option, but the sellers don't.
So
it's like
we do. So we do that in the follow-up works related to the rental market. So we have a frictional market for capital goods that are new, so new to some extent, so they become old at some rate. And then the older capital has to be traded frictional. And then we have heterogeneity of firm to ask which one would buy in which market. So yeah, I think you can do that. I think my sense is, I think, it matters in particular if you have heterogeneity of firms to know which of these firms would go toward buying the used capital versus the new one. And so, yeah, I would think so. I mean, some of these arguments, I think they seem, certainly the one I've done so far seems, robust, that they would apply to the part of the capital market where you have those frictions. But you can think of extending in a way that is more realistic.
Yeah, and I was thinking this missing depreciation is something that kind of takes away the responsibility of having to sell capital because there is just it reduces on its own anyway. But it also increases the needs to buy new capital because you have to replenish. So these asymmetries between the buyers and the sellers could lead to depreciation, for example, mattering for, but whether it is there or not doesn't matter. Okay. Anyways,
yeah. So I don't have it here. Yeah, we have that when we have this different generation of capital layer. Yeah, I would say for this AK version, I would say it's not going to affect some of the results. Even here, I don't think it matters, but it's true. It's generating these additional forces, right? That pushes you to buy more capital as capital depreciator. Here, I think it would go toward the direction I'm going to describe, as a matter of fact. Yeah, so you can see. So here it's a production function that has correct with respect to your own K. Now the productivity of the firm has an adjacent component as before AJ, but it has an aggregate component that depends on this index of experience, as in R, that would be equal to the aggregate stock of capital. So, and that's the idea that the knowledge creation is associated with the production of the capital, and it's non-rival, so it's going to be shared by all firms. So yeah, I can look. So here, I can look at the first best. So I'm going to compare to that. The main point is all firms now should have some amount of capital given the curvature. The model is still very tractable. So I don't have a lot of time to go through that, but there is a way to solve so that you are going to compute the value of the firm, thinking about the next time it will have the option to resell. And then you will have those two terms, so you can compute the output until you have access to the market. It's also done by a separate Penman equation, and then you can compute the resale value. The point here that you can see that there is those terms showing up. So the productivity of the firm becomes a hat. So there will be that static misallocation capturing that A hat term. And then you can see that the reinterest rate is reduced by a term that depends on that growth rate. So this is this Gordon effect. There is growth in productivity, in aggregate productivity, that is going to reduce that effective reinterest rate, or that effective discount rate.
Guillaume,
Okay,
sorry, I might just be a bit slow, but like it seems so like this knowledge accumulation, like the firms are pretty passive then, right? It's just a function of the aggregate capital stock. They don't make individual decisions to contribute to it, right?
No, not this. So you choose your own K, but the capital K is something that is that is given to you. So this is aggregate productivity, but aggregate productivity is going to be endogenous and depend on the decision of all firms. So this is the hours idea. When you put a new machine into the economy, you change the environment and then you create new ideas essentially. Okay, so at that point, once you have the value function in closed form, yeah. So everything's solved. Even the heterogeneities, you can characterize the entire distribution of capital across firms. So all miles is retractable on all the dimensions. So here, this is the demand for capital for each of those firms. The market clearing is written in flow, and so you could think of writing it as just taking the distribution of this firm. Here, you only need to do it in flow. A flow of firms access the market. The demand has been characterized on the previous slide, and the supply is going to be the capital that those firms bring in the market, K, plus the new capital that is produced, the K dot, which is G times K, right? The growth rate. And then we can characterize the reinterest rate. So the reinterest rate will look like what the planner would want, R star, but not quite, right? So the planner would have A. In the equilibrium, we have A hat. So the effective productivity takes into account the frictions. There is a beta term, that's the knowledge externality. So all these tend to push down the reinterest rate. There is a term that has to do with the firm only access in the market inflows. So I call that a congestion effect that tends to also to push down the reinterest rate. And then there is a last term that has to do with this growing productivity. I call it this capitalization effect. That is going to go in the other direction. That's going to push the reinterest rate up, as a matter of fact. So I'm going to skip those limiting cases. They work well, right? So the model, can go back to the linear case, can go back to the frictionless case. But what comes out of it is, so you have this holder problem, and because you have this holder problem, the firms are trying to avoid them. They have two reasons to trade. So they are going to have their strategy to avoid the holder problem is going to be in response to those two motives. The first one is because you have the idiosyncratic shock. So you know that the idiosyncratic shock makes you trade. One way to avoid that is by taking a position in terms of your capital stock that is closer to the average productivity that you might draw. So that is going to push the interest rate down. That's creating that static misallocation, pushing it down. But then you have the second effect, that is the aggregate productivity is growing. So you know that you will want to trade more in the future simply because aggregate productivity is going up. So again, you want to anticipate on that so that next time you meet the broker, you have less to trade. Right? And that stands to mitigate the learning externality and then in fact push the interest rate up. So there is a proposition in the paper that shows under some conditions, so there is a part of the parameter space where the reinterest rate is in fact larger than its frictionless value. So you can have a higher interest rate and a higher growth rate than what you would have when you remove the frictions. Now, you're still less than the first bet being R star almost by definition. But the competitive equilibrium is not at the first best because of the knowledge externality. Okay, so this is the condition where you know, for one set of parameter values, this is a condition where that's going to be the case, the gray area. So you know, it doesn't take that much, right? It's going to be relatively robust in terms of the alpha, in terms of the theta. You can see, right? You need the bargaining, you need this holder program to be operating. So you need the bargaining power to be sufficiently close to 1. But you know, except from that, you know, you can get that type of result. Okay, so I'm out of time, so let me just show. There is a calibration here. So calibration, you can see the bargaining power comes high out of that, but the bargaining power is also high in Gabbard's paper, for instance. So the bargaining power comes from the capital reallocation. The capital share here is important because it drives the size of the externality. I argue that, you know, it's not inconsistent with, let's say, Jovanovic and Rousseau for some category of goods. But just to conclude, is going to be this. So here, this is the real interest rate as a function of the friction. There are two things. It can be non-monotone in the friction. So as you reduce the friction, the real interest rate and the growth rate can go down. And it's higher than the frictionless value. The frictionless value in that example being about 4.8. Okay? And you can see that high bargaining power can generate higher growth, higher interest rate, higher growth. And that can be translated into welfare, even though you worsen the static misallocation. So it's not guaranteed that you are going to raise welfare, but you know, you have a welfare result that says removing the friction can in fact lower welfare. Okay, so I will stop here because I'm out of time, but I would say I would just show that. I have some follow-up papers where
Might
I
as
go
well say
into
that now, yeah.
I go into some of these market structures. So with Michael and Yi and Yan with a PhD student from Rennes University, and also with Pierre Olivier, where we go into the marriage market aspect of that. So two-sided heterogeneity.
Awesome.
And indivisible good and entry of firms.
Thank you so much,
guys.
Guillaume. We can't wait to see those papers here next. So we have 15 minutes of open discussion, and we will also take questions from attendees if you want to post your questions in the Q&A. Thank you.
Did I stop the share? The sharing? Oh, okay. So let's see in case the...
Guillaume, I have a quick question about the data. Do we know anything about whether these surpluses, whether these dealers extract the surplus primarily from buyers versus sellers? Like, do we have like the price that is bought at, sold at, and a comparative your market price? Yeah.
Yeah, so that I don't know. I in fact don't know. Yeah, I would like to have more in terms of this idea of this bargaining power, the market power of these intermediaries. So I can tell you, I mean, I've talked to some brokers, to some dealers, as a matter of fact. The more traditional dealers that have inventories, there are still some of those. So in that case, I have to say, so the transaction that he would describe to me would be buying. So let's say we'd be buying some machines at Ford. So they would be typically through auctions. So in that sense, not much bargaining power on the buying side. But then you would be selling, I could see the difference in some of these transactions would be very large. So you would multiply by a factor of 5. But the delays would also be very large. You know, there is a lot of specialization. So you would describe this transaction where it would take a couple of years for one machine, and one machine would still be in its inventory like more than 10 years later. So very long delays, but yeah, it seems, I mean, very, very large markup. So for my son would be more on the selling side. I would be my intuition there. We are trying to run a survey. So we have the list of all the dealers in the US. We're trying to run a survey to get a little bit more into both the delays and their source of market power.
That'd be great. Yeah, thank
I guess 2 questions. One, just circling back, I guess, on the innovation side is like the sort of non-monotonicity results that you have seem like very similar to the innovation results if we just substitute out market power of the product markets versus market structure on the other side. So it might be interesting, maybe with data or something like that to sort of think about the variation in the search frictions and the market structure over time compared to the variation in the product markets and competition there, to just sort of like think about how much the different mechanisms might be playing a role there. One other question I have is like, in the simple version of the model that you had, Tobin's cube was like the top productivity. Tobin's cube was 1, and so the variation, the positive association with Tobin's cube was essentially just you drop capital when you're below, and otherwise you're indifferent. With the knowledge externality, the learning by doing later on, is itself the case that the top highest productivity is the distribution of Tobin's cubes that you get are sort of bounded by 1, or it's above?
No.
Okay.
Yeah, now it's above.
Yeah, kicks it up. Okay.
Yeah. In the second case, you get Tobin's cube above and below 1. Yes, I think it might be more realistic in that front. So you get a distribution of the Tobin cube. I mean, for many reasons, right? So yeah, because those firms are hit by this productivity shock, the idiosyncratic one, and they cannot readjust as productivity is also growing. So all that create that distribution of Tobin's cube, and again, larger than 1 and lower than 1.
It'd be interesting to highlight maybe the difference in the distribution of firms, Tobin's cubes or capital or something compared to this other literature, like the Clem-Cordon style things. You have 3 entry and slightly like it's so there'd be some differences in the distributions of capital, but I think it might be interesting to flesh that out.
Okay, yeah. I mean, I like the idea with the connection of market power in the goods market as well, right? So here I don't have that, but obviously it's important in the growth literature. So.
So Guillaume, going back to the rental possibility, do you foresee that may reduce the holdup problem if you create a?
Yeah, I think it does. I think so. In the version that we have, because so when the firms are trading, so the way we describe it in that that's the second paper with Pierre and the other 2. Here you're not subject to a holdup problem in that case. You can adjust your capital continuously through time. So we describe it as completely frictionless. Sorry. So I do think in that case, but here it's kind of combining 2 things, because I also make it frictionless. So in that sense, by assumption, I shut it down for that segment.
I see. Because I also thought that may interact with whether you want a rental. I understand that this is a different your other paper, but when you combine the rental and the selling, whether that interacts with lambda as well, right? How likely is that you're going to change whether you want to select into the rental market or the buying market?
Rental markets in general are pretty tricky in economics. In the housing market, should you own or rent? In the car market, should you own or rent? I don't think economics has much of value to say about all these rental versus purchase decisions. It doesn't mean it's not important. It's not obvious how to do it.
But you mean, and I don't know much about that literature. So but that's a choice, right? So there should be conditions under which you prefer selling or, buying or renting.
So we do have that
it comes up in the repo market. If bank wants to do a deal, uses its T-bills as collateral to get a loan, you can think of that as the counterparty renting the T-bill. Why don't they just sell the T-bill? They don't need a loan.
Exactly.
And in frictionless markets, it's a version of Modigliani and Miller. It just doesn't matter.
No, exactly. In the frictionless market, it doesn't. But not here, right? So I
Which
can
will
foresee,
matter here.
right?
I think maybe.
Yeah.
I mean, okay, so here, but you know, where I agree with Randy here, we have to make some assumption on the, so that we, by assumption, we say the rental market is reserved to the new capital because this capital is less subject to that depreciation and so on, maybe more easier to evaluate and so on. And the older capital, when you age at some point, then the rental companies don't want to deal with that capital and becomes a capital that is traded in that frictional value. But it's still very much by assumption, that distinction that we make, right? But then at that point, the firms are going to select themselves, depending on their productivity and the technology, into going into the rental and adjusting continuously through time, or going into the owning or alternating. So we have those three possibilities, depending on productivities.
Right.
So, you know, the original idea of Kittle and Prescott is to write down one formulation, one framework that accounts for growth and business cycles. A lot of the capital reallocation literature, including a lot of the papers you cite, are partial equilibrium, kind of static, no real frictions, no liquidity considerations. So the modern work on this is, you know, making big improvements. It's a lot to ask for, but at some point, I'm composing an email to you right now about what we should do in future research. Getting one model that hit the business cycle facts about capital reallocation and growth would seem to be a great idea, if you know, if it can be done.
Yeah, I agree. I mean, in principle, right? I mean, so it is, you know, there are some models, like, let's say, you know, Otenelo, or, I mean, in principle, one of these models can be used. You can do the business cycle, and there's no reason not to be able to do the growth, right? So that's where sometimes it's
Absolutely.
a choice. It's a choice of focus, right?
Yeah. See, one thing we get, I'm not sure if you get this. There's two holdup problems in models with liquidity considerations. I'm going to say it slightly differently. Suppose there's a lot of frictions in the capital reallocation market, the secondary market. That could lead to more or less investment in the primary market. It leads to more investment because if you need to buy capital, you know, it's hard to get it. So you invest more in the primary market. But it could lead to less investment because if you want to sell your capital, if you don't need it after a negative shock, it's harder to sell. And which of these two effects dominates will depend on the bargaining power.
Okay.
So that means that when you decrease the frictions in the secondary market or change the bargaining power, investment in the primary market and hence output, wages, and consumption can all go up or down. There must be something like that in your model.
Yeah, not quite. I think that might depend on the assumption that I make in terms of how you trade, right? So here, from the viewpoint of the firm, I think it might be possible to get something like that. But here the firms always need to go through the dealers when they are buying any type of capital.
But they still have, it's a frictional market where they meet the dealers, is it not?
Yes.
Okay, so something similar might be true. It's harder to find a dealer when you want to buy capital. It's harder to find a dealer when you want to sell capital.
Yeah.
Which of those effects dominates could change primary market investment positively or negatively.
Okay. So I have to think more about this.
Yeah, we can chat more about this.
Yeah.
As I say, I'm composing a long email to you.
Okay. Thanks, Ronnie.
Guillaume, there seems to be a question in the chat as well.
Oh, okay. So I'm not sure. Let me see. Okay, so so the shocks might be.
So Andre Silva, if you want, you can ask. out loud, but I can also read out the question. The shocks might be real frictions.
Yeah, I think so.
Firms can insure against the idiosyncratic shock.
Yeah, so here, yeah, you cannot. I mean, that's key. You cannot insure against those shocks. I mean, that was predicting that Holder program. I mean, if you would have a way, I mean, here, if you would have a way to contract, I mean, form a relationship with the dealers in particular, contract in advance based on the realization of your shocks, yeah, you will mitigate those effects or eliminate those effects. So yeah, I would tend to say yes.
Okay, thank you. Guillaume, I have a quick question. So you mentioned that the real interest, I mean, the return on financial wealth R can be greater than the productivity of capital. Is it?
Yeah, the R can be larger than the average productivity of the capital.
Or
The average productivity. Yeah, not.
But it's always less than AH.
It's always less than AH. Yeah.
Okay.
Yeah. Hi, Jacob.
Hi, Guillaume. Super interesting talk. If I might ask you to speculate, I'm just very curious. In looking at the impact of search frictions on a growth model, in some ways you have at least two choices. You know, you've chosen to look at search frictions in the capital market, but you could, you can also instead look at search frictions in the input to capital markets, which is labor, for instance, and see how those search frictions impact growth. And I'm just curious if you'd be willing to speculate about whether the magnitudes would be roughly similar or not. What's your intuition here?
So labor versus capital.
That's right, because I mean, in reality, there are frictions in both of these markets, right? In redeploying or capital or changing your capital stock, but also
That's a great idea. But you know, the literature on the importance of Pissarides model basically has no success getting capital in there in the first place. So it's going to be a tricky thing to do. It's interesting that the model you talked about would be great. You have frictions of capital and labor markets, but the leading labor market model, more in Pissarides, basically doesn't have capital, and it's a real bitch to try to get it in there.
Yeah. So
go ahead.
Yeah, no, my intuition would have been that somehow the capital should matter more because
for growth maybe.
Yeah, through growth and through that link to these externalities that have been mentioned. But even some of these effects, I could see that the growth rate could be larger. So some of the effects sometimes can work in really counterintuitive ways. So it's in that sense a bit hard to speculate on that, but there's some literature which I think the relevant one seems to be the one by Lance and Mortensen, for instance. That seems to be the one that is and the follow-up paper.
Physical capital, I don't remember.
No, they don't have that, but it's a labor version in some way.
Without capital.
Yeah, and focusing on the Schumpeterian approach, right? So the innovation part. So yeah, I mean, I would agree that ideally you would like to have the friction in both inputs. Yeah, maybe the intuition would be that the capital would matter more, but I think and I don't have much to back it up.
Yeah, I mean, my intuition is that it would be sort of phase-space dependent in the sense that you could buy all the capital you want, but if you don't have enough labor to, use it productively, it doesn't matter. On the other hand, if, clearly if you can have as much labor pool as you want, but if you don't have the capital to be able to, utilize that, so what's not clear to me is what exactly would drive one versus the other. My question was a little more modest. I mean, yes, involving both frictions at the same time would be ideal, but even getting a sense of which of these frictions, just in terms of magnitude on its own, hits harder using calibrated models, would help me at least, and that's why I'm asking.
Okay. Yeah, I don't have an answer to this, unfortunately, but I agree. What I can say is I was hoping for a large effect, right, for the capital. So when in the welfare section, so I mean you can get them, but that's going to depend on like the size of this externality. So I was initially thinking that the effect of the friction would be magnified through the capital accumulation. You can see if beta is 0.8 in that case, yeah, you get this large welfare gain from removing the friction. But then on the other hand, through the externalities, you can also get these welfare losses. So in that sense, yeah, the calibration would have to be done very carefully in order to answer those type of questions. Not that it has not been done carefully, but there are obviously some parameters that are a bit tricky, in particular here, the size of the externalities. Yeah, Chengxing.
There's another question in the chat. Vladimir Yankov have a question or comments that basically, I guess if the firm may face bankruptcy and capital reallocation may more likely be happening when firms are under bankruptcy, and maybe in those cases, dealers have greater market power or bargaining power.
Yeah, so that seems right. So the bargaining power could depend. I mean, could depend on the nature of the shock and then the outside option of this firm in different cases. So I'm reading at the same time. I'm trying to.
Well, in the used car market, you can sell your car in an hour if you take it to a dealer, or you could try to sell it privately, which takes longer, but you don't have the same bargaining issues. So this is true of the capital market, I would presume too. You guys do they have to trade to the dealers, or can they trade one-to-one like in many versions of DGP?
Yeah, I think it's more complicated when you do it. So again, that's where some of the chapters in the book of Ben and Cotters can be useful for that, but it becomes more complicated. But you could imagine that. So certainly one thing that is easy to do is you can have direct access to the market at some rate and access to dealers. That you can do.
Yeah, and even the related to some of Lago saying work. Even if people never use the dealer to dealer, or sorry, the car owner to car owner market, the fact that it's out there will discipline the bargaining of the dealers, not through bargaining power, but through the outside options.
Yeah, absolutely.
Okay, I got to go to lunch. Excellent talk.
Thank you, Randy.
Bye, everybody.
Bye-bye.
Bye, Randy.
So I think since Randy is leaving, that concludes the official part of our online meeting.
Hey, Randy, you're left. You're at lunch.
So I'll stop recording.